The opinions expressed in this show are the views of the host and not necessarily that of WTRW, 94.3 The Talker, or the Bold Gold Media Group.
The following presentation is paid for by Century 21 Jack Ruddy Real Estate, who is solely responsible for its content. Portions transcribed.
All Century 21 real estate offices are independently owned and operated.
Hi, I'm Jackie Ruddy, broker, Century 21 Jack Ruddy Real Estate. Welcome to the Real Estate Roundtable on 94.3 FM The Talker. I am here with my husband, co-host, fellow realtor, Pat Devaney.
Good morning, Jackie. How are you today?
How are you is the question.
I'm doing great.
Yes.
I'm doing great.
I'm doing wonderful as well. We're here with Tom Cawley, CPA and partner of Cawley, Johnson & Sanders. Good morning.
Good morning, Jackie. Good morning, Patrick. How are you?
Very good.
Thank you for being here. You're no stranger to our program. You've been here before, but you haven't been here for a little bit. So we're looking forward to our discussion with you. We're here every Saturday at 11 a.m. and Sunday at 11:30 a.m. We talk real estate. We have a full-time real estate office with many relentless realtors. We've been listing, selling, and appraising real estate for 50 years.
50 years. Wow. During the week, feel free to email us with any questions you have at questions@jruddy.com. That's questions@jruddy.com. Or you can give us a call at 570-344-6724. And when you go to jruddy.com, we have a roof cam on the roof, and you can see Dunmore Corners. So click on that and see what's going on at the corners.
Is it fixed? Because it went out.
We're working on it. It's under construction, but it's still working. It's still up. We're getting an upgrade.
Well, someone that I know very close and dear to me says consistency in life is everything. So if it's not working, people are going to move on. You're not going to get as many hits.
Wow. I know. I think that was directed at me. I could be wrong. What do you think, Tom? No?
I don't know. I'm looking forward to seeing Dunmore Corners.
Okay. You can't.
It's pretty good because one night a guy was drunk and he crashed right into the front of Fidelity, right up the steps.
And he didn't know who was driving his car.
And then he got out of the car and he's walking around the car and a cop comes driving by and the guy goes, "Well, I wasn't driving."
So you blew the whistle on him?
Well, the tape doesn't lie.
Okay. Uh-oh.
And they always come to look at our tapes. Right?
Mm-hmm.
Even the state police.
Digital media files. No more tapes.
View our listings, search the MLS listings, and listen to archive radio shows by going to mobilefriendlyjruddy.com, JRUDDY.com. All of our archive radio shows are also on podcast apps, most popular podcast apps. If you go to jruddy.com and you click the radio tab, you'll see all those podcast apps that we are on. Also, we're all over social media, so check us out. Tom Cawley, CPA and partner of Cawley, Johnson & Sanders. Can you give me a little brief background on you and your company, how long you've been doing what you do, where you're located?
Sure. We're a full-service accounting firm. We are located on 1310 Lackawanna Trail in Glenburn, which is right outside of Clark Summit, right on Route 6 and 11. We primarily do financial accounting and income tax work. We have a staff of 9. There's 5 CPAs and some other accounting staff. And we're busy year-round. We do all kinds of tax work, but a big focus of our work is income tax work. You know, federal, state, local, individual, and business entities.
Nice. Okay. So you've been doing it for a long time. I knew you back before you were a CPA.
Yes.
And it was grueling for you because you had a full-time job, you were going to school, and then you had to take that big exam, but you did it all. All right, let's talk about buying versus renting. There's many advantages of owning a home, right? So can we talk about the potential tax break for owning a home?
Sure. There is still tax deductions related to homeownership. However, due to the tax changes in 2018, they aren't not as many people itemize their deductions as they once did. However, mortgage interest is still fully deductible, and interest rates are very low right now, as you well know. So you have to have a pretty sizable mortgage to have enough interest to deduct. The standard deduction is now in 2021 will be $25,100 for a married couple. So they can itemize their mortgage interest and their real estate taxes. And they can also take, if they're within the income limits, any mortgage insurance premiums that they pay. And in addition to that, any points that they pay on the original purchase of their home. One of the big questions today, and there was a lot of confusion in the tax changes related to home equity line of credit interest. And that is deductible as long as the proceeds from the line of credit were used to either improve your home or as part of the purchase of your home. The old days of refinancing your house, taking the equity out and paying off all your personal debt to convert it to deductible interest, that loophole was closed in the new tax changes. And but it's only for lines of credit or home equity loans after December 17th of 2017. But there are a lot of other tax benefits to owning a home, and also financial benefits. You know, you can really make your money work for you. You gain that equity in a home residence, and if you can buy one earlier rather than later, you can possibly build up some equity to move into your next home, which is always a big thing. The mortgage insurance premiums are put in place when you don't have enough down payment money to get your loan. But one of the things to look at when you do that, there are some financing options out there right now. One is like an 80-10-10 loan where you get a mortgage for 80% of your property and you put 10% of the purchase price down and then get a home equity line of credit for the other 10%. And if you do that with a local bank, maybe the local bank will hold the line of credit and sell the mortgage. And that will get you out of the mortgage insurance premiums. And you can still deduct all that interest because that equity line is part of
is used
the
to purchase.
Yes.
Okay,
Well,
got it.
you can still deduct the interest even with the standard deduction?
No, you cannot. So that's one of the big changes. The standard, it's more impactful probably for a young married couple because the standard deduction for a married couple is $25,100. So if you take your mortgage interest and your real estate taxes, which are the two big items on the itemized deductions, and add to that your state and local income taxes, and then your charitable contributions, that has to exceed $25,100 or you wouldn't itemize. And one other change in the tax code was the limit on the taxes is $10,000. So your combined state and local income taxes as well as real estate taxes cannot exceed $10,000. So if you have 10 there, to get $12,000 of mortgage interest today, for example, you have to have a pretty sizable mortgage with interest rates being
low,
2.75 to 3.25%. But the other thing that the interest rate structure now affords a great opportunity to younger people to get mortgages for a shorter period of time. You know, you could still get a 15-year mortgage at like 2.25%. So if you can pay the payment, you can really reduce the amount of interest you pay over time, and you increase your equity in the house pretty quickly.
Right. A lot of people don't realize how much interest they pay over 30 years.
Yes, interest is a function of the rate and the time. So if the rate is low and the time, the length of the loan is shorter, the interest is significantly decreased.
Yeah, we refinanced a couple of years ago. We had a 30-year mortgage, and we went down to a 15, and it was in the twos, and my mortgage payment was maybe $200 a month more, but I cut 15 years off.
Yeah, correct. And back, you know, I bought my first home in the late 80s, and I believe my interest rate was about 12%
Yeah.
I remember
on my
that.
first mortgage. And, you know, I thought I hit a home run when I got it refinanced at 5.5.
Yeah.
And now if somebody's paying more than 3, they think they're getting the
getting
short end
screwed,
of the
yeah.
stick.
Well, okay. So what comes to my mind is, okay, so the 15 makes more sense. If you can swing the higher payments, right, so that you pay less interest in the long run and build equity quicker.
You're saving a huge amount of money.
What if you took a 30 because you're more comfortable with that monthly payment and maybe made a payment or two extra a year.
That is a good play, too, because then you're not locked into a bigger payment. I think as a rule of thumb, this was going back a few years ago when interest rates were a little bit higher. If you took a 30-year mortgage and made one extra payment a year, you would cut 7 years off your mortgage.
Right.
So if you take a 30-year mortgage now and make even a payment and a half extra a year, you could probably get it down to 20 years or less. I would have to calculate it to see what that number is, but it would significantly reduce it again, because again, it's the amount of the loan and the rate and the time. So when you make an extra principal payment, you're reducing the amount of the loan.
Right. So I used to do that when I first started buying my cars. I used to hit it extra a year. I would try to at least. And but life has a way of getting in there, and your unexpected expenses come along. So I never wanted to
Lock into the bigger payment, right?
But I'm a little bit more risk averse than you are. I mean, you're usually a risk taker. I am not, but I had no say in that 15. That makes me nervous. But also worth noting is that there are other options. You can do a 20. You can do a 25-year too.
Yes.
It's not just 15 and 30, although that's what we usually talk in terms of.
Yes, and different banks are offering all different terms. One of the other things to look at when you're a potential home buyer is there's a lot of programs out there for especially first-time home buyers that aren't necessarily tax-related programs as much as banks participating in closing costs. Maybe the FHLB, the Federal Home Loan Bank, has some programs where they'll contribute matching for closing costs. So that's a big help for somebody who's trying to buy a home and come up with some down payment money and also have the cash to close the loan so that they don't have to borrow the closing costs. You know, they can get some help with the banks.
Let's talk about borrowing those closing costs, although these type of buyers have been really unable to secure a property these days. They're having a harder time convincing a seller that their offer is one to take, because a lot of sellers, it's a seller's market, are in a position where they have multiple offers, and sometimes they have contracts that are, the price is really, really good, but it's the type of financing or no financing. A cash offer is usually, if it's a strong purchase price, is usually the one that most sellers want to take and entertain. But when you have a cash offer, a conventional mortgage buyer, and then you have an FHA or VA buyer, most sellers just aren't taking the time, because the FHA and VA buyers need that seller's assist, which is on top of the purchase price. We have appraisal issues to worry about, right?
Yes.
And then, of course, there's always that question, well, what are my tax consequences as a seller if I'm going for this larger amount?
Well, the seller's assist is really, we treat that as a closing cost for the seller. So it does really reduce their sale price. On the sale of home residences today, the capital gains on those are, excluded for the most part. As a married couple, you can have up to a $500,000 capital gain tax-free. And as a single person, it's $250,000. So you have to sell a property for a pretty large amount of money to have that size gain, because you remember, you bought the property. So if you buy a property for $200,000, you have to sell it for more than $700,000 to have a gain of $500,000. The seller's assist would come off. I think one of the problems that people have with financing today and seller's assists and that is the banks are mandated to use the lower of the appraised value or the sale price. So when some of these houses in today's market are probably selling for more than what they appraised for just because of the times we're in, and the banks are not going to use that higher sale price if it doesn't appraise at that. So they're going to use the appraised value and give you a mortgage for 80%. You got to put 20% down, or you got to do that, some kind of creative financing where you get that other 10%. So that can be a hurdle. So that's one of the reasons why sellers are forced into this seller's assist, is to bring the amount of money the borrower has to borrow down so that they meet the requirements. A lot of young people today make enough money to make mortgage payments, and it's cheaper a lot of times than renting. However, they don't have that cash to put down, and that's a hurdle, and then you not only have the cash down requirement by the bank, but then you have to close the deal. So, you would know what maybe a percentage of a purchase price is in closing costs.
6 to 8%.
6 to 8% for the buyer.
For the buyer and for the seller.
Yes.
Right.
So that's a consideration that young couples have today is they don't have that amount of cash put away.
Sure.
So they're getting seller's assist is a big thing.
It is a big thing, and it's very helpful, but it's not. They're getting shut out of this market. As we just...
Yeah, if I'm a seller and I say, listen, I got this guy with the mortgage or $2,000 less for cash, I say, I'm going with the sure thing.
Especially people coming into the area that have sold homes outside the area and they have the cash available to buy homes here. Mm-hmm. And if they're coming from a bigger marketplace.
Right, because then somebody will look back, they'll look at the deal and say, well, but my offer was higher. But,
right.
But you say no.
It's not always higher.
No, it's not.
It's not always higher. It's the terms. The terms
of the seller's assist.
They think that they're taking the shaft, but it's terms, like Jackie says.
But, talking about capital gains, many people are still under the impression that the one-time rollover after age 50 is still the treatment for gains on the sales of homes.
No, that changed years ago. So for the sale of a home residence today, now we're talking your primary residence. This is not a vacation home. It's not a second home. It's the home where you live.
Right.
And it's where your vehicles are registered and you register to vote and you get your mail, and people try to play that game where they have a house here and a house there and they end up want to sell the vacation home first before the primary home. So they want to try to convert their residence. So to meet the requirements for the tax-free gain, you have to have lived in your primary residence for at least 2 of the previous 5 years. They do not have to be consecutive 2 years. It just has to be 2 out of the previous 5. And the gain on the sale of that residence is tax-free up to $250,000 for a single person and $500,000 for a married couple. So essentially, you could do that every 2 years. Because you will meet the requirements. It will be your home for 2 years. You have to own it. It has to be your primary residence. It has to be in the United States.
So if someone purchased a home and sold it just shy of 2 years, they're subject to capital gains.
It's prorated if they don't have it for the full 2 years.
Okay.
Prorated. So you would get, if you were, 18 months into that 2-year window, okay. I'm pretty certain it would be allocated in that ratio. And you would pay gain on just a part of it. Okay. And that would be a capital gain at the long-term capital gain rates.
Okay.
As long as you owned it for more than a year.
Okay. With us today is Tom Cawley, CPA and partner of Cawley, Johnson & Sanders. How does someone get in touch with you, please?
My telephone number is 570-563-1140. My email address is tomc@cjspc.com.
Thank you, Tom. Pat?
Yes, we have a 2-bedroom, 2-bath home at 319 Union Street in Peckville for only $124,000. It's a lovely home. It's got large room sizes, a low-maintenance yard, and a 1-car garage on a quiet street. This cute modern home has a covered front porch along with the modern kitchen and baths, but the best part is the low taxes. It's only $1,200 a year in taxes. That's a 2-bedroom, 2-bath home with a garage and low taxes at 319 Union Street in Peckville for only $124,000, and that's listed by Paul Mackerel of our office.
Don't go anywhere. You are listening to the Real Estate Roundtable with Century 21, Jack Ruddy Real Estate, on 94.3 FM The Talker. We'll be right back.
The talented team of professionals at Century 21 Jack Ruddy Real Estate. They're not just real estate agents, they're agents of change. They're on a never-ending quest for the best for you and your family. They can help you find precisely what you want at this time in your life. A computer, a website, an app, and a listing by itself can't do that. They're obsessed with better and deliver extraordinary, embracing the what if, not just the what's been done before, with a level of accountability and honesty not found anywhere else in the real estate industry. Don't settle for average, okay, or just all right. This change in your life is monumental, and there's only one Century 21 Jack Ruddy Real Estate that will help you rock that change. Call 570-344-6724 and visit jruddy.com, JRUDDY.com. Each Century 21 office is independently owned and operated.
Welcome back to the Real Estate Roundtable with Century 21 Jack Ruddy Real Estate on 94.3 FM The Talker. I'm Jackie Ruddy, broker, and with Pat Devaney, my husband, fellow realtor.
And we're back.
And we're back with Tom Cawley, CPA and partner of Cawley, Johnson & Sanders.
Welcome back, everybody.
We like to call him the tax man.
The tax man. You're very popular. You're as well liked as realtors.
Yeah. Just don't blame me. I'm just the messenger.
You're the
I don't make the rules.
I know you don't, but you do abide by them. In the first half of the show, we talked about tax deductions for homeowners. Now I'd like to ask you, how do you calculate the cost basis of your home?
Yes. So related to the tax-free capital gains on the sale of home residences, you have to know what your basis is in the home that you bought or that you're selling. So your cost basis is your purchase price plus the closing costs, the capital closing costs when you purchased, which would have been things like the attorney's fees and the transfer tax, title insurance. Transfer tax on a real estate transaction is not real estate tax, not deductible in the current year on your tax return. It gets added to the cost basis of your home.
Okay.
So you have your purchase price is $100,000. You have $5,000 of capital closing costs. You got $105,000. Then you take all of the renovations that you do over the time that you own the house. Capital renovations. You put a new kitchen in, you put a new bathroom, maybe you do a driveway.
How about a roof?
Put a roof on the house.
Windows.
All of that, windows. You add all of that to your cost basis. Now, keep in mind, you get a tax-free gain of $250. So once you calculate that basis, whatever number that is, if it comes to be $180,000 in our example, then you get to sell the house for $430,000. Because remember, you will also deduct from the sale price the sale costs. So if you pay a realtor fee to my favorite realtor, Jackie Ruddy,
Thank you.
At a mere 6% of the sale price, and there's a couple other closing costs. You might have a transfer tax again, the 1%, and you pay your attorney fees. So you deduct those costs from the $430,000. Or in essence, you add them to your cost basis. And just that difference, if it's less than $250,000 and you're single, it's tax-free. If it's less than $500,000 and you're married, it's tax-free. Do that every 2 years because you have to meet the requirement of living in the home for 2 years. And if you don't live in the home for the entire 2 years, there is a prorated calculation for how much of that gain you get to exclude. And oftentimes you still get the whole gain excluded.
On the months that you're short.
Yeah, on the months that you're short. So if you only live there for a year, I believe if you're single, you would still get $125,000 tax-free gain, half of the $250,000. And if your gain's only $40,000, then you wouldn't pay any tax on it.
Okay, good to know. How about tax credits for home?
Yeah, we talked mostly about deductions in the first part of our discussion, and they are somewhat minimized by the current tax code, is the ability to write off. And that's the question everybody always asks, can I write off my mortgage interest? Well, the answer is yes, but will you? Maybe not. So that all depends on the situation. But there are some other issues. One is still one more deduction to talk about real quick is a home office deduction.
Right.
Everybody always wants to know about that.
Especially now in COVID.
There's no deduction for a home office expense for an employee. Employee expenses, unreimbursed employee expenses were eliminated in the tax changes in 2018. So they're no longer. However, if you are self-employed and you work from your home, you have a area in your home dedicated to that, you do your ordinary course of business, meet with customers, all of that stuff, then you could take that percentage of the deductions on your Schedule C. That might be a place you can get some of your interest in real estate taxes if you're not itemizing. When we talk about, credits that we get with homeownership, there are a few out there. One of the questions I'm often asked is related to medical conditions that a taxpayer might have, and they spend some money on some kind of durable medical equipment, or they might put a stair glide in their home. They might put a wheelchair ramp in. It could even go as far as you build your home and you're handicapped, so you have excess expense because you have to make it handicap accessible.
Bath shower conversion.
Yes, that kind of stuff. Or when you build your home, you have to have wider doorways. You need a bigger garage because you have to get out of your van.
Right.
All of those are deductible, but they're considered medical expenses, though. So, again, everybody doesn't get that. Probably what's more appealing right now is the credits that are out there. A big one right now with the movement toward climate control and all that is solar.
Right.
And geothermal heat systems and so forth. So you can get a pretty big deduction or a pretty big credit on that right now. I believe for this year it's 26%, and it's phasing out, and it's to be gone in 2024. However, that may come back depending on administration at that time.
Sure.
And where they are with climate control. But that's a percentage of the cost of the installation. So if you put a $50,000 solar system in and you get a 25% credit, you get a credit of $25,000. And that's a credit against income tax. And it is carried forward till you use it up. So that's a direct savings. So now your $50,000 solar system or geothermal heat pumps and that really only costs you $25,000. Okay, and that's a big pitch right now. There are also some credits related to home improvements, energy efficient, whether it's windows, doors. There's even some roofing material that qualify. However, that keeps coming and going. That has been in and out of the tax code for probably 20 years. Yeah. And it was supposed to be an aggregate number at one time. So if you took it in previous years, you're not supposed to take it now. However, the credit is not real big. But again, a $500 credit's a $500 credit.
Something's better than nothing.
It's in components, so much for insulation, so much for doors, windows, things like that.
Well, that's why we rely on you. Tom Cawley, CPA and partner of Cawley, Johnson & Sanders. Thank you for today. Will you come back next week? Because there's a lot more I want to talk to you about.
Sure, I guess, if the pay is right.
Okay, thank you, Tom. Pat?
Yes, we have a 3-unit building at 314 Willow Street in Dunmore for $259,000. This building has 2 one-bedroom apartments and a 2-bedroom apartment, and it produces very good income of over $17,000 a year. The taxes are less than $1,200 a year, and it has low operating expenses, making this an excellent moneymaker. The property has undergone major renovations, and the apartments are beautiful and modern with gorgeous floors. This building has new kitchens, new baths, new electrical, plumbing, windows, floors, and more. And it's also got, my favorite part, it's got a 2-car garage in the back that you can rent out.
That's too small for you.
But I wouldn't rent it out. I would use that one.
Yeah.
So that's a 3-unit at 314 Willow Street in Dunmore for $259,000. That's listed by Dan Callahan of our office.
Thank you. Tom Cawley, CPA and partner of Cawley, Johnson & Sanders. How does someone get in touch with you, please?
My phone number is 570-563-1140, and my email address is tomc@cjspc.com.
Thank you. I'm just going to give everybody a little reminder that, not that anybody doesn't know this already, winter is coming again.
Really? I had no idea.
So check your chimney, check your roofs, seal everything up, windows, doors, so on and so forth. Disconnect garden hoses from faucets. That might be obvious, but someone near and dear to me forgot to do that one year. We had a problem.
I have no idea. Who could she be talking about?
And
The pool boy?
yeah.
I don't know.
We don't have a pool. And of course, don't forget to clean your gutters. Thankfully, we have a window outside in our master bedroom, and I can see out and I can look down at my garage and I can tell when those gutters need to be cleaned.
That's good for Patrick. Then he never gets behind on
That's
the gutter
it.
cleaning.
Yeah,
That's when I call the gutter guy.
Okay. Thanks for tuning in to the Real Estate Roundtable with Century 21 Jack Ruddy Real Estate on 94.3 FM The Talker. Remember to tune in next Saturday at 11 a.m. and Sunday at 11:30 a.m.